And good afternoon, everybody. Victor Bales, USA Mortgage. We've been talking a lot about the market. Interest rates are going to fall, the magic May 10th date. I want you to hear it from Barry Habib here. You guys have seen a lot of the arts and charts I've been showing you there about inflation and shelter costs and all that. This gentleman can explain it quite well. So go ahead and enjoy, and let me know if you have any questions at all, and we'll go from there.
They've gained some ground. Let's talk for a minute about the Fed. We know that the situation we're in right now with higher interest rates, we see what's going on in the banking sector. We know we're headed for a recession. What does all of this mean? It means that what we have to do is try to figure out how we got here, so hopefully we don't make mistakes. That's what normal people will do in the future. You want to protect yourself, right? By seeing what went wrong. Well, when you take a look at the Fed, they don't have the ability to admit they were wrong, look at things in the past. They're making the same exact mistake that they made just 2 years ago when they came in like a wrecking ball. Now, I want to show you, because I think this is worth explaining, because I think this can give us very good clues as to not just where we came from and where we are, but most importantly, where we're heading and why we think interest rates should head lower for you. So let's go through this step by step, because it's worth an explanation. So first off, we've been showing you this, and now it seems like a lot of people are catching on. I'm seeing more and more, both people in the economic world that we listen to suddenly discover this. And certainly we've seen it even on TV, where this is a sudden discovery, where, obviously we've been working with you on this for a couple of years and showing you this. But this is showing you real-time rents. And the real-time rents are going up at 2.6%. Why is this so important? Because shelter costs make up 43.2% of core CPI. Why is that so important? Because mortgage rates directionally are going to follow inflation, and core CPI is a big function of that. So this really helps us understand where inflation will go. That means where mortgage rates will go, and that will also influence demand and real estate value. So this is at the very key of what we're trying to do. It's a critical understanding that we need to have. So we see in real time, we're coming down. But because of the lag effect, it looks at the last 12 months, you're going to take slices of what happened in the past. And someone surveyed that's paying rent and was surveyed here might have signed their lease here. So there is a very large lag effect. And that's why now, while this is just rents, you're going to get something similar in a larger component, owner's equivalent rent. And as we've explained to you many times, there's also a shelter away from home component. So all of these things play into where that shelter cost is, but it's coming in right now at 8.2%. And unfortunately, this is what the Fed is looking at, because this is what goes into the calculation, which right now is causing CPI, we did the math on this, to be overstated quite significantly. The core CPI is 5.6% year over year. But if you were to go real time instead of what was being shown within this lagging indicator, it would actually be 3.2%, and the Fed wouldn't be screaming for additional rate hikes. And they're going to hike again, folks, on May 3rd. They're going to hike again. That's the crazy wrecking ball aspect of this. They're going to hike again because they don't understand this. Now, we'll just take you down memory lane here, because how did we get into this mess? It was the Fed's lack of understanding. Now, Wayne Gretzky, probably the greatest hockey player, maybe one of the greatest athletes ever, said that a good player skates to where the puck is. A great player skates to where the puck is going to be. And that's what we should be doing. What we want to do with you guys, we always try and look at where the puck's going to be and try and forecast. But unfortunately, the Fed doesn't buy that. The Fed will skate not to where the puck is going, not to where the puck is, but sadly, to where the puck was. And you can see this every time they speak, and you'll hear this over and over. We're going to be data dependent. They're data dependent, but data is old. Data is what you saw there with that blue line that's lagging. And it's not the first time they've done this. Look, remember in 2021, they were begging for inflation, every single one. And we don't have all the pictures here, but all of them. We want more. We want more. We want more inflation. Why did they want more inflation? Well, if you look back in 2021, inflation was very low. It was about 1.5% right here. So they were begging and screaming for more. We want 2%. We'll take 2.5%. We'll do some averaging to take it to 2.5%. So it can go even hotter than that. Everyone's screaming for more inflation. By the way, all the same people now yelling and screaming for more rate hikes, but were the same ones, not 20 years ago, but 2 years ago, saying we need more inflation. We've got to have more inflation. We can tolerate it. But maybe the biggest band leader might have been Janet Yellen. Now, this is not a stranger to Fed policy. She was a Fed chair, not a good one, but she was a Fed chair when she was screaming in March of 2021, go big, go big. Inflation, it's too low. It was so simple, folks, because all they had to do was look at this. You see, the Fed was data dependent. They're driving while only looking in the rearview mirror. And they're seeing that, hey, we don't have to worry. We need more inflation because the shelter component was keeping it low because it only represented 2.5% year over year inflation as reported in CPI. And the rest of the components were down. So inflation appeared to be low as per the report. But remember, this report lags. It was taking into consideration this lag period of time. So of course it seemed low. But meanwhile, what was happening in real time, everyone? In real time, rents were skyrocketing. They were going up 15%. The Fed ignored it. The Fed focused here where the puck was. They didn't even focus on where the puck is, never mind focusing on where the puck is going. And that's why we're in this mess. And the results of this are just what you see here. Inflation runs rampantly. Mortgage rates have had to follow when they stopped. But what could they have done? See, they kept QE going. They should have stopped QE right here in 2021. If they would have stopped it right here, if they would have started hiking rates gently, we would not have this craziness. You wouldn't have to hike 500 basis points, 375 basis points in less than 4 months. You would not have to have the disruptions to the market. You would not have to put us into a recession. We could have been in a much better place. You would not have 6.5% mortgage rates. Now, look, would you have 4.5% or 5% mortgage rates? Probably. And maybe that would not have felt very good, but it sure would have been a lot better than the 6.5% that you're seeing right now. And of course, consumers wouldn't be suffering. We wouldn't be heading for that recession. So simple, so easy. But instead, the Fed remains data dependent. Why they don't get this, I don't understand. But team, here's the thing, is one of the fallouts from this, of course, is what you're seeing with SVB, with First Republic. Deposits are fleeing. Some of their mortgage-backed securities are on fire sale, and that's why we aren't seeing yields come down more on mortgage-backed securities right now, because there's more coming to the market as some of these banks are forced to unload some of their holdings. Now, they're certainly culpable in their poor risk management. They were asleep at the wheel. In fact, SVB didn't even have a risk officer. They were worried about other things in La La Land. But when you take a look at the Fed's role in this, they were certainly a big player. This could have all been avoided. So we talk about this because this tells us where we're heading. We're now heading in a position where we're heading for a recession. We're going to see, by the strangling of the economy from the Fed, by going again too far, making the same mistake because they're not looking at where the puck is going. They're being data dependent, looking where the puck was. They're looking at inflation that is being held up by old data from shelter instead of the fact that it's already coming down. They've already gone too far. And incredibly, on May 3rd, they will even go further than that in doing the wrong thing. The result for us, lower yields, lower rates, and a hot real estate market.
Showing further signs of weakness.
There you go. You got it from the expert there. So I follow this guy pretty religiously, and everything's lining up to just what we said. So I hope you enjoy this. You got any questions, give me a call. Talk to you. Bye-bye.